Robert Pavlik, Chief Investment Strategist, SlateStone Wealth. Hi, Robert. Good morning.
Good morning to you.
Thanks so much for joining us on the show. Obviously, we're looking at oil having its worst day in possibly, a really large period of time. And these kind of prices, they just seem a bit off. So low, one really can't bridge the gap between the demand, supply, and the price war between Saudi Arabia and Russia. What's your read on this whole thing?
It all started when Saudi Arabia wanted to try to reach out and touch Russia and teach them a lesson to show them who's in charge when they couldn't come to an agreement on reduction after the OPEC meeting. I think what you're going to see is oil stay down probably for 2-3 months. I wouldn't be touching it here. I think what they'll probably end up doing is taking some production offline here in the United States, the crackers. But I think that, no one's going to win this oil war. And sooner or later, Russia and Saudi Arabia is going to sort of have to come to terms. Saudi Arabia needs the cash probably as much as anybody else. Their whole kingdom's built on oil money. So let's face facts. They're not going to do this forever. They have a big Saudi Aramco company sitting out there. That's going to get punished. So I do think it's going to probably last 2 or 3 months, but I wouldn't be touching oil. I think if you step back and you think, oil has driven the world for so long. Now people are moving to alternative sources, electronic vehicles, wind turbines. That's where I'd probably want to focus my energy exposure going forward.
Robert, good morning. This is Cheryl on the other side. Talking about actually crude and staying on that particular topic, if you look at the Brent crude and NYMEX, it definitely recovered this morning. The Brent is already pairing off those gains that it's been seeing. For how long do you see the crude market actually seeing a decline? How much more can it actually fall? Around $20 or something was unseen for NYMEX, at least for us in our history, for the time that we've been in the industry. So how much more can the crude actually fall from here on?
It's a good question, and honest to God, I don't know. That's the best answer that probably anybody can give you. It's as long as Saudi Arabia is willing to stand the pain. That's the real answer. If it's $20, if it's $18, if it's $15, I never thought I'd see $15 oil. But this is the way they want to handle it. And again, I'd sort of be avoiding the space right now. A lot of folks came on television, especially here in the U.S., touting energy. I came on television here in the United States right at the end of December, and I said I'd be careful with it. And this is what's turned out to be. And I had no idea Saudi Arabia was going to do this. But, again, I just think the world is going in a different direction.
I have, Robert, is that China contributes to 80% of the world's incremental oil demand. At least that's what we've been told. Now, the situation in China seems to be improving in terms of the fact that they were hit first and had the largest pandemic first. They seem to be sorting out their issues, and businesses there are slowly picking up again. At least that's what we're picking up from the cues. So you would think that two large producers, Russia and Saudi Arabia, being one of the key players in the world, would be able to come to some kind of standstill arrangement, given that they both don't really want to see the price of crude eroding. The way both these... Yeah, sorry, please go ahead.
I agree with you. You're right on. You're right on. China is ramping up a little bit at a time, but the rest of the world is actually slowing down. So where are the products that China makes going to go? So China's only going to be able to ramp up as much as the rest of the world is ramping down. We're going to have to meet somewhere in the middle. This is almost childish between Saudi Arabia and Russia. But as a consumer of oil, my car runs on gasoline. I'll be happy to take it.
Sorry, go ahead.
Robert, just wanted to get your view on the equity markets, the volatility that you are actually seeing at one point in time, when if you want to actually gauge the futures market, the futures will be up around 200 points. In this next minute, they wipe off all their gains. How should one actually gauge the volatility in the market, and if they want to actually go ahead and invest, is it the right time to actually put in your bet in the market?
I'm sorry, I lost you during that question.
I just want to know how should investors actually gauge the volatility in the market, and is this the right time to actually go ahead and put the bets in the market?
So I think if you have a long-term time horizon, you really want to continue to focus on that. That's the key to all this. If you're going to need investment dollars in a short period of time, less than a couple of years, then you really shouldn't probably be in this market at all. For clients who are able to keep that long-term investment horizon, I think you have to approach this knowing that this volatility is going to continue until the number of cases, especially here in the United States with the U.S. equity markets, really sort of begins to show vast numbers of people that are infected. That I don't know what that number is going to be or what it's going to look like, but I do know that once we do start to see a real spike up in the number of cases, that's going to start to signal the beginning of the end of this volatility. The world is going to go through an economic recession. There's no doubt about it in my mind. And, I'll be honest with you, I never gauged it to be as bad as it is going to get. But I'm not alone, and I'm at least willing to tell you that. I think what you're going to see is a spike up in the number of cases, people really going to sort of hit the panic button. Bill Ackman was on television here in the States today saying it's going to go to hell. It's just nonsense to me. I don't think it gets that bad. It's going to be a confidence issue. People having confidence whether or not the companies are going to lay them off. Companies going to have the confidence that their businesses are going to bounce back. If this virus issue can get over relatively quickly, despite the number of cases that they're going to be, people infected with it, and number of deaths that are going to be, the market's going to probably see that confidence drop. But if it takes too long, that confidence can wane even further, and then we have a more extended problem. If that issue happens quick, and there's a shock to the system, we can get over that fairly easily. And then I think from an investor standpoint, you want to be looking at quality names, the best of the companies out there, no matter if they're in India or Singapore or Hong Kong or here in the United States. You want to look at the best of the best, the companies that are really going to survive all this. And you want to start to put a little bit of money in at a time. And I'm talking if you're looking at maybe a 5% position in one name in XYZ, then don't buy 5% now. Buy maybe a 1/10 of that or, a quarter of 1%. And buy on the way down. You're not going to be able to catch the bottom, and you're going to see this rebound if it's quick, very quickly. People are going to be chomping at the bit to get into this market, and you're not going to be able to get in. You're going to think it's bypassed you, and it could very well likely. So I'm saying buy a little bit on the way down, wait some, buy a little bit more, wait some. You're going to probably experience some pain, but that's the way to handle this. That's the way to invest in this market.
We leave it at that. That's Robert Pavlik of SlateStone Wealth advising that staggered investment is the best sort of investment in this kind of particular market, and you cannot actually gauge where the crude is headed from here on.